Hello, everyone. Today on the final bar, we're going to wrap the week. Look at how the last 5 trading days have shaped the trends and momentum that we've been following. S&P pulling off, chopping around for most of the day, finishing down about 2/3%. The real story, though, is this continued rotation of leadership with technology continuing to be a weight on the market instead of being a leadership role. We're also going to be answering your questions from the final bar mailbag. Ladies and gentlemen, this is the final bar. Hello, everyone. Happy Friday. Welcome to the Final Bar. This is your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to break down the activity in the markets, make sense of the flickering ticks, try to draw as much conclusion as we can from the patterns reflected in the charts, and most importantly, especially on a Friday, connect the short-term movements we've seen today with the long-term trends and see how the trends have evolved. And every Friday, we wrap the week, meaning we look at the last week of trading. We now have the new weekly close locked in. What's happened to the major asset classes, sectors, themes, and what conclusions can we start to draw? And for me, and what I hope for you, this begins sort of the weekend process of market review, market analysis. When the markets are closed, a lot of times that's the best time to try and take a step back and review what's happened. So it starts for me on Friday, continues through the weekend, making plenty of time for personal time, recharging, relaxing, and then coming back on Monday and seeing what we need to do about it. Now, coming up on StockCharts TV next week, we have some wonderful guests on the show this week. I was super excited with some of the guests. Al Brooks in particular yesterday was really, really interesting. Monday on Behind the Charts, my guest is Steve Suttmeyer. Steve's the Chief Equity Technical Strategist at BofA Securities in New York. I've known Steve for a number of years. He actually started his career as a fixed income analyst. So I've always found people that started in the bond markets focus a lot more on risk, on potential downside than people that started in the equity markets. So I had a cool conversation with Steve about not just his technical approach, but also just the formative events in his career. I think it'll make you think a little bit. And then coming up on the final bar on Tuesday, it's Keith Fitzgerald. Keith runs his own shop called KeithFitzgerald.com. He's actually based part of the time here in the Seattle area, the other part in Japan, but a really knowledgeable strategist. On Wednesday, Louis Yanis, who runs a firm called WealthNet Investments. And then Larry Berman is going to join us on Thursday. Larry's pretty prolific in the Canadian financial media on BNN if you're from up north of where I'm at. But Larry, I've known for a number of years, is going to join us. He runs ETF capital markets. So should be really, really fun week on StockCharts TVs, particularly on the final bar. Let's get to our market recap. So as I mentioned, today as we look at what's evolved, thinking about our wrapping of the week here, it's been a lot of movement here. I want to just update very quickly on what happened today. I want to share with you a poll, and then we're going to get to a deeper analysis of the weekly trends today. So the S&P actually finished down almost 2/3%, sitting around 3215. Mid caps down a little bit more, but small caps really led the way lower. So this rotation back into small caps that we've been seeing sort of took a breather today with more of a risk-on move, really continuing the risk-on trend that we saw yesterday. The NASDAQ 100 led the way lower with the major indexes, with the technology sector, the XLK down 1.2%. Very quickly on the other markets, the TLT was flat. So bonds were flat for the day. The dollar continued to weaken, going down another 0.4%. So that weaker dollar theme, strength in emerging markets, that's all been a part of it. The commodity side, gold really was the leader there, natural gas and others as well. But in terms of the major commodities we've talked about, gold really led the way further. I want to share with you a poll, and the reason why I'm bringing it up now before we get to sort of our main segment is because this is something to think about as you start the week. And my question to all of you, what's your favorite time for a weekly chart review? Friday after the close, Saturday, Sunday morning, sort of coffee time, Saturday, Sunday evening, more of a happy hour with charts, or first thing Monday morning or some other time during the week. The overwhelming majority voted for Saturday, Sunday morning coffee time, which is awesome. That's actually when I enjoy doing it as well. What often I found, though, is to be honest with you, I end up prioritizing personal things, family things, and around Sunday evening, I think, you know what, I really want to spend some time digging into the chart. So I actually end up doing it more of a happy hour of sorts with coffee. So it's sort of a mashup of those two answers, I guess. But the reason why I ask that is not necessarily to tell you there's a right answer. There's a right answer for you, and not a perfect answer, but something that you will find fits most into your process. And I think that was the reason why I asked that question. Think about your time over the weekend when the markets are closed. Think about where you can prioritize a review of the markets when there's no stress, there's no pressure to be taking action. It's more of a time of reflection, just like you hopefully do in your personal life, mentally and spiritually and other things. Spending some time looking at the markets in a non-stressful time can be really, really valuable. I would think about when's a good time to schedule around that, and think about what the most importantly I would say is get into a consistent time when you can do it every week, because that's where I found people really elevate their process, elevate their decision makings if they have a routine time to go through the charts of interest to them. Thanks for answering that poll. We'll have a new poll running here shortly on StockCharts TV. Let's get to our Wrap the Week segments. This is where we're going to spend time using the Mindful Investor Live chart list. And the goal here is to look at how the longer term trends have evolved over the last week. We're going to start with a weekly chart of the S&P 500. I call this my market trend model. And basically, this is looking at long-term weekly data with the moving averages, 21 and 34-week exponential moving averages. The long-term trend for me is defined by the difference between the 21 and 34-week moving averages. This turned positive in early June, has remained positive through this week. So continues to tell you the longer-term trend is positive. For me, the medium-term trend, I use the weekly PPO, very similar to the weekly MACD, and just use a simple crossover system. That turned positive here in mid-May and has remained positive through this uptrend. Even with the pullback that we had out of the June highs, it's remained sort of long and strong in the uptrend. The short-term tactical read for me, again, I usually use the daily chart for sort of the tactical trend, but I like just having everything on one chart just for simplicity. So week to week, what's been the change between those two moving averages? And it's actually gone down today. Those moving averages have tightened up a little bit. So basically at this point, it's long-term bullish, medium-term bullish, short-term bearish based on the pullback that we saw today. Let's look at a daily chart. This is where I really would rather focus when I'm thinking strategically. And what jumps off the page for me is what's jumped off the page looking at a chart of the mega cap tech names, the mega cap communications names, consumer discretionary, all those sort of key leadership sectors that have had this bearish divergence, higher highs in price with the June peak and the peak we've seen recently, and then lower peaks in the RSI. So higher price, lower momentum is called a bearish divergence, and that suggests a weakening of sort of internal momentum. It tells you that there's less upside pressure on that second move than the first move. And again, the challenge with that is that's what most major tops tend to look like. If you look back here in January and February, you'll see a similar pattern of lower peaks in the RSI, higher peaks in the price. Now, this pattern had emerged on major technology stocks, had not really come out on the S&P yet. I think given the sell-off we've had over the last couple of days, you can sort of acknowledge that we've had higher highs in price now with a new swing high that we've established, and now lower peaks in the RSI. So what that tells me is it's really suggesting limited upside. It's suggesting more potential for downside than upside overall. And I think we've seen those warning signs with technology, the strength in technology starting to dry up. Thinking of the limited upside with potential with a clear resistance level at the February highs. What's the potential that the entire market could break above 3,400? I think the chances of that are actually relatively muted. When we broke out above that June high, though, my suggestion was I wouldn't be surprised if we hit 3,400, but I certainly feel like there's going to be some downside in here. So we actually could satisfy everybody. I think in the short term, what happens is the divergence puts it on my radar. It's not a raging sell signal. It tells you that a downside potential is imminent. For me, I'd want to see some validation from the trend. So the first things that would happen would be you start breaking down through trend lines. So if you connect a trend line using the late June low and the mid-July low, which actually just broke below that maybe yesterday to today. So that might be the very first thing. Second thing would be lower highs and lower lows. We've not had that yet. So until you start to reverse this pattern that we started in late June, it's telling you that the uptrend is still positive. So trend line break, check. Lower low, lower high, not there yet. Breaking down through key support in the form of moving averages also has not happened. So I'd be looking at the 50-day moving average. These lows from July, that's sort of that 3100, 3110 level. That's sort of the potential downside for me at this point based on the divergence. And if and when we break that, I think you have to reevaluate what's happening. What's interesting, though, is a breakdown like that will usually be reflected in individual stocks before it'll be reflected on the broad market averages. Let's go as quickly as we can through some of these other charts so we can wrap the week effectively. Next one is looking at breadth in the form of the cumulative advanced decline lines using my very subjective color coding system. I think it's positive for the S&P 500, for the broader NYSE, for the broader mid-cap index. I still see that as neutral, and I see it as neutral for the small-cap index as well. The mid-cap index is actually very close to breaking above the indication from the June high, which was also the same level that we had in February and the same level we had in January. So if we would break to new swing highs there, that would confirm what we saw in the S&P. It's not quite there yet, and I think it'll pull back a little bit today. This isn't updated through today's close just yet, but given how mid-caps pulled back a little bit, I would expect that to come off and not quite validate an upside level yet. So I think you have the S&P positive and all others neutral at this point. In terms of new highs, we've seen an expansion in new highs. And as we've talked about previously, a sustained uptrend is met by more and more stocks making new highs, because while the S&P is nowhere near really its high from February, that 3,400 level, a lot of stocks, as we know, in healthcare and tech and consumer have already broken above their February highs. And this is illustrating the number of stocks in the S&P, over 10% yesterday, broke to a new 52-week high. That's not a zero number. That's not bad. But you'd want to see a continued expansion of that and get back to the levels that we have seen in sustained uptrends, which we're not there yet. This is an interesting take. I think when you look at the percent of stocks above the 200-day moving average, we have over 50%, which makes me comfortable in the fact that the market overall is in decent shape. If and when we get back below 50%, that's when I start to think more like a bear and less like a bull. So again, that's another level I would be looking for. And again, not that that's a signal, but it's a signal for me. It's an indication to revisit some of the charts and see which ones are breaking down, because that means stocks are breaking below their 200-day moving average, which tells you some of the trends are reversing. We talked about the AAII survey yesterday, so I won't dwell on it, but just to note, I think if you look at the percent of bulls, it's nowhere near where we've been at previous highs for the most part, right? Highs usually have been 40+% bulls, and if you look back at some of the major tops going back, that's where it's been. We're nowhere near that, which tells me there's not this, even though it feels euphoric, and with certain anecdotal evidence like Robinhood accounts, it certainly feels like the Wild West of the late 90s euphoria, but I think on certain measures, it's not quite there yet. I think breadth is one way, and I think looking at the AAI survey as well. We are going to look at the name exposure index a little later in the show, which does actually give some signs of euphoria. Looking at the ratio of consumer discretionary to staples, interesting to see that this ratio has leveled out in the last couple of weeks, which suggests on a cap-weighted basis, discretionary staples pretty much even. It's actually been relatively neutral now for the equal weighted version, as well as Amazon sort of right-sized it a little bit as staples like Kraft Heinz have emerged. Overall, they're sort of netting each other out. This is the really interesting takeaway on this chart, though. This is the ratio of consumer discretionary versus technology. This has clearly been favoring tech for a while now, and it's just almost barely breaking to a new 5-month high or so, 4 or 5 month high, which would be a very much a change of character, rotating away from technology as leadership, rotating into consumer discretionary as more of the leadership space. Interesting to see the two consumer sectors at the top of the list of S&P sectors just on today's trading alone. The relative strength of semiconductors, the long-term trend remains very positive. This week, the ratios turned down a little bit, put in a bit of a lower high here. So I think seeing a breakdown in this ratio next week would continue to confirm that rotation away from tech into other places. Now, traditionally, that would make me very nervous about the overall health of the market, because semiconductors tend to be a good bellwether group to illustrate overall market health. So that would be one data point to pay attention to. At this point, I think more than anything, it would illustrate this rotation away from tech, where I think a lot of investors have been parking for a while. This I tweeted out earlier, sort of ate it a bit on this one. I remember talking about this potential bear flag, the downtrend in the relative performance of small cap versus large, the upturn in that and then we broke down through support. This is the first week in July, sort of signaled a rotation away from small caps back into large caps. From then, it's actually rotated back higher, so it's more in the neutral phase here. So interesting to see. It's actually coming up a little bit. If this is able to break a new swing high, get above where it was at the end of June, that would make me a little more confident about nibbling in small caps a little bit. At this point, it still tells me to be wary and think that it's more of the larger names that are driving things. Growth versus value has taken a bit of a hit. That's the regular growth versus value indexes. The next one we'll look at are the pure growth versus pure value, RPG and RPV. They both pulled back a bit, but haven't really broken down yet. A breakdown in that ratio would be similar to what we saw back here in early June, which suggested a real change. This has been favoring growth over value for a long, long time. That would be an interesting rotation of sorts. The U.S. overall has stabilized a bit versus the world in the month of July, but it's really coming off highs that established in April, May. So overall, that long-term trend is still favoring non-U.S. versus U.S. stocks. I think that's an important theme to pay attention to as the dollar has weakened. EM continues to impress, rotating higher versus EFA. And then the very last chart I want to show you is stocks versus bonds. I put the amber neutral arrow, which I haven't used in about a year because it really isn't favoring either of the two. Stocks have been rallying, bonds have been rallying, and overall, the trends in general remaining positive in both places. So I think it's pretty much even between the two. We're going to take a quick commercial break, back answering your questions from the Final Bar Mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the show. This is Dave Keller here at StockCharts.com. Two ways to get a hold of us anytime. First off, via email, thefinalbar@StockCharts.com. Second is on Twitter @FinalBarSCTV. Just tag us in a comment there. Also, on our YouTube videos, anywhere you see our content, feel free to leave a comment. We read everything that you share, and positive feedback, negative feedback, we look at that as a team. We're always trying to improve what we do and get you the best insights, best guests, expertise that we can. So we'd love to hear from you on feedback, but also questions on what you're facing as you're trying to analyze these markets. And on that note, let's get to the Final Bar mailbags. These are questions we've received from you in the last couple of days, and we've received so many great questions. Really appreciate it. Many of you have actually shared images of charts you're looking at, and I can't thank you enough for that. It's very easy to understand what you're saying when you include the charts. So send us more questions anytime. Question number one. It appears that low volatility stocks are finally showing an indication of outperforming the S&P 500. You included this chart, so I hope you don't mind me sharing it with the crew here. And I think, this top series is showing you the ratio of SPLV, the S&P 500 low volatility ETF, versus the S&P 500. I think you're highlighting this rotation a bit higher, and you're absolutely right. What's interesting with the low vol index, there's actually two common ways people look at low volatility. There's SPLV, which is the low volatility ETF. There's also USMV, which is the minimum volatility ETF. I'd encourage you to look at the two of those just so you're clear on what you're doing, because they pick stocks a little differently for those. The SPLV is designed to have names that traditionally have a low volatility. And also, I would say when you're buying a factor or a theme ETF like this, pay attention to the sector weightings that you're going to get. Something like this would be a lot of healthcare names, I would guess. I don't know. I would think utilities. That actually might not be right, though, in the LB. I'd have to look at it a little further. But I would pay attention to that because you're going to you're going to get affected by some of the sector leadership and laggardship in a factor ETF like this. A lot of times there's sort of an unintended bet you will make on something like financials or healthcare if you're not familiar. So overall, I would agree. It's a merge. I usually look at high beta versus low volatility. That's on my Mindful Investor Live chart list. I think it supports sort of what you're saying here. My only observation on your chart is at the bottom, actually, you have on balance volume, accumulation distribution, and EMV. All of these are basically different volume creations. On balance volume is Joe Granville's volume read, which takes every day's volume and rolls it up into a cumulative read. Accumulation distribution is Mark Chaikin's version of this, and EMV, I'm dipping into my knowledge of indicators. EMV, I want to say, is Dick Arms's volume indicator. So you can see the patterns are all very similar. I would encourage you to really think about whether you need all three of those. While all three of them are going positive, it's sort of like if I had MACD and PPO and some other things all moving average oriented, they probably confirm each other a lot of the time. What's interesting is, though, they actually did not confirm each other here February to March, because on balance volume actually treats the entire day's volume as positive or negative, and it's based on close to close. So if a day jumps down, it's going to consider that all negative volume. You can see the accumulation distribution actually considers that a positive volume because it closed more on the upper end of the range. So the subtleties of how these are calculated are going to give you some different reads. So maybe you're onto something there with that question. So short answer is, I see what you're saying. I agree, and I think that would be a different theme than people are familiar with. My longer answer is take a look at some of those volume indicators. I would bet you don't need all three of those on there. It's maybe a busier than you need. Question number 2, what kind of value or insight, if any, can we gain from comparing the closing price to the previous day, current week, or previous week's closing prices? Yeah, talking about closing prices versus open, high, low, close. So as you can see from the charts I show you, I almost always look at bar charts, open, high, low, close. Occasionally we'll look at candle charts as well, and I find both of them are valuable. If I was more of a swing trader, I'd be using candlesticks a lot more because I think they provide a lot of clarity on that short-term price dynamic. But you're basically asking, is there something to looking at just the price, just the closing bars? No, I'm sorry, the closing values as opposed to the high and the low. And some analysts absolutely favor this. Jeff Weiss comes to mind. I spoke to him earlier today. He's one of my mentors. He's a longtime technical analyst. He was at a firm called Jessup and Lamont, which is one of the oldest Wall Street firms still in existence. And he swears by weekly and monthly closing prices. And during the week, I'll get all excited and I would send him something and he would tell me nothing has happened until the weekly close on Friday locks, and then you can get excited about a change of anything. And there's so much wisdom in that. So some people, really insist on trend lines drawn from the closes and not the extremes of highs and lows, because that you pick up on a lot of noise in the volatility. So the thinking goes, the closing price is where things settled. So by the end of the day, all the trades happen. We agree that that is the final trade of the day. And so there's certainly value in that. And I could probably stand to spend a little more time focusing on close to close as opposed to open, high, low, close and getting caught up into some of the noise in there. I think there is something to be said for the volatility, though, and that's why I tend to look at that. So the shorter answer is absolutely. My friend Jeff Weiss does such a good job in his research stressing that. So I'd encourage you to look him up. Next question. It's been a while since the S&P has had 2 consecutive down days, and the last time that was scary. I'm frightened to bring up this chart, but here it is. You didn't update this yet for today, so I'll do it for you here. We'll go back to today. So I think today we finally got 2 down closes as we did, and that's the first time since right after the June peak. So thanks for that gift going into the weekend, and I see what you're saying. So my observation of this is absolutely, I think you've seen some distribution unlike what we've seen in a while. I would hesitate to draw too much conclusion from that in particular, because you'll find back here April and May, you found 2 down days actually was kind of the ultimate time to buy. That was when things pulled back within an uptrend. So the question is this the beginning of some further downtrend, or is it the pause that refreshes before we continue on? And again, I think it's still too early on to make that conclusion. That's why I pay attention to the recent swing lows. As long as we remain above the most recent swing low, by definition, the trend remains positive. If we start to break that, and on individual stocks, if you start to break that, I think that's where it's interesting. That's why with a chart like Tesla, which is, obviously had earnings this week, was a huge story stock, had a bearish engulfing pattern, until it starts breaking down through some of these support levels. I think you have to just think of it as a reasonable pullback that any stock should have during an uptrend. If we start to break support, that's where you have to worry. So I think a trend line on the March lows on Tesla is a really important one to watch right about now. We have time for another question. Yeah. I enjoyed your recent show comparing investing to flying. I got to wondering about having an emergency plan to know what to do with your investments ahead of time before troubles arise. I heard Chris Chivacco calls his studies of market downturns bird strike analysis. I didn't know that. That's actually great. My question is, practically speaking, how do you implement your emergency plan? Do you do it with stop losses that kick in when prices hit a certain level? I didn't watch your show until April, so I'm curious how your process worked in February and March of this year when the market quickly lost altitude. Would most of your holdings sell on stops? Did you ride it out, put the nose down, and wait for the market to gain speed and pull back up? So a couple observations. Number one, by your question, I can tell you either flown or you know people that do, because you correctly pointed out what to do with the nose in the case of losing altitude. So I think you still are onto something there. And again, I'm glad you enjoyed the recent show. And I apologize again. I lost internet here at the Keller household, and so we had to scrap the show at the last second because I wasn't able to get online. And now they've basically recreated our internet connection here at the local utility, so we're back up and running. So the good news is that show ran. The bad news was because I couldn't get on and do the show live. But to answer your question, there's no one right answer to answer that, to be honest with you. And I think when I've worked with investors, I've encouraged them to develop their plan that fits with their risk appetite, how quickly they would want to get in and out of things, how they tend to build positions. So some people are, in and out with larger positions. Some are scaling in and out. Some are more, risk averse. Some are more, comfortable with risk. And so I think it's hard to answer that in one way. I think hopefully you've picked up just on some of the charts I've talked about in this show. I tend to focus on a trailing stop of sorts, and whether that's based on a moving average or something like the chandelier exit, average true range, or even just the most recent swing low, there should be some level that you agree right at the beginning. When you enter the position, when this happens, I'm going to reevaluate that position. And so I think that's something you need to answer for yourself as you're developing your trading plan. I can tell you that having something like that, the more important than what exactly your plan is that you have one, that it's well designed, and that you stick with it. I think the consistency of an imperfect plan is going to trump an inconsistent perfect plan, if that makes sense to you. I don't know if I said that right, but I think so. So again, you hear what I say. I tend to look at recent swing lows. Higher highs and higher lows are an uptrend. We start breaking down through support levels, I get concerned, and that's where I would start to do it. And in terms of February to March, when we broke down through the swing lows, mid-March, that's where I started to get worried about charts like Tesla going materially lower. Those are our questions today. Those were really fun to answer. I hope you enjoyed them as well. And thanks so much for sending those in. Those all came from you in the last day or two. So thanks for sharing your journey with us. Thanks for sending questions our way. We need to close off the show. Go to the 3 and 3. 3 charts in 3 minutes. Here we go. Chart number 1 is looking at the S&P and breadth in the form of stocks above their 200-day, stocks above their 50-day. We talked about this earlier. And as the market pulls back in some way, and again, I would not lose your mind thinking of the potential downside. Not much has happened yet. We are still really high up in the range that we've been in over the last 6 months. So it's not the end of the world by any means, even though it's felt negative because we haven't had this sort of down day in a little while. There are things that I think you should focus on to make sure that you don't get scared out of a good working long position. For me, one of those broad market indicators is the percent of stocks above their 200-day and ensuring that it remains above 50%. As long as that does, I feel okay about the overall health of the market. If that starts to break down, I start to revisit positioning and thinking. Chart number 2 is looking at the AAII bull and bear spread, and I think the thing to focus on here, as we mentioned yesterday, is just the lack of bears relative to what we've seen historically. And again, this isn't, for me, it's not the most tradable signal in the world. I bucket it more with anecdotal evidence and use measures of breadth as a way to validate what I'm seeing on the sentiment read. But I think it's worth noting that there's a material lack of bulls relative to where they've been at previous highs. There are plenty of bears around relative to previous lows, by the way. The third chart, continuing on the sentiment theme, is looking at the name exposure index. This is the active investment managers, and looking at what percent they're allocated basically to equities. What portion are they allocated relative to what they would normally do? And you can see, looking at the current level, about 98% relative to where it's been, we are pretty much at upside extremes. It's not been 100%. It doesn't mean when we reach that the end has happened. It just means we're potentially getting to the level of positioning that has matched historical market tops. So that puts it on my radar. As a trend follower, I'm looking at what happens with the price from here. But again, looking at the weekly bars, I'm seeing the S&P close down toward the lower end of the week. It's a shooting star pattern. If you know your candlestick analysis, suggests short-term weakness. So I wouldn't be surprised if next week we see further weakness from the big tech names, further rotation, overall the S&P drifting a little bit lower. I could be wrong. Folks, that's our show for today. Thank you so much for joining us all week on the Final Bar. Have a great weekend. We'll see you next week. Until then, for StockCharts.com in Redmond, Washington, I'm Dave Keller. Take care.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.